Hello, my name is Elliott Gue. I'm editor of Personal Finance as well as the Energy Strategist. I want to talk a little bit about earnings season, which of course has been the big news here over the last couple of weeks. Second quarter earnings season. Generally speaking, it's been better than expected. That helped to propel that 7% July rally we saw in the S&P 500. Roughly speaking, around 77% of companies in the S&P have already reported second quarter numbers. About 3/4 of those have beat on the earnings line, and around 2/3 have beat on the revenue line. Now, you'll still hear a lot of pundits out there say, all the growth that we're seeing out of companies earnings-wise is coming from cost cutting. None of it's from final demand. That's actually complete rubbish, and the numbers have been saying that for some time now. Actually, every single sector within the S&P 500, all 10 of them, are showing year-over-year growth in revenues. Not surprisingly, that's led by the energy and materials sectors, benefiting from higher commodity prices. Both those are showing about 23% year-over-year sales growth. But the S&P as a whole is showing about 11% year-over-year sales growth. So there really is sales growth out there. There really is that final demand. Obviously, cost cutting that's been done over the last year and a half has helped to accelerate that. But companies really are seeing improved results. They also have an awful lot of cash, and they've really taken steps to reduce their debt. And if not reducing the total amount of debt that they owe, certainly terming out their debt structure. In other words, replacing short-term credit lines that have to be rolled over with 10 and 20-year type corporate bonds, extending their need to refinance. And that's been a big positive for companies. They actually look to be in pretty good shape overall. So what are some of the trends that we are hearing out of companies? Well, I think that on the energy side, which of course is a sector that I recover quite closely, we are seeing an impact from the Gulf Coast drilling moratorium, but it's been particularly minor for the services companies. Companies like Schlumberger and Weatherford are showing relatively small hits as a result of the drilling moratorium. What we're seeing outside that sector is actually very, very positive. Onshore U.S. drilling activity has been very, very strong, suggests a lot of confidence on the part of U.S. producers. And internationally, we're seeing a gradual but steady increase in activity. That's a sign that companies abroad, producers abroad, are becoming more confident in relatively high oil prices. And when I say relatively high, something between $75 and $85 a barrel is probably what you need to see in terms of an average level to incentivize, big new exploration production type projects. And that's really what we've been seeing. And I also think that reflects, a realization that there's probably not going to be a double dip, and that demand is going to be pretty decent for oil going forward. So the energy sector has been pretty solid. Other areas where we've seen pretty good growth, technology. The GDP report that we had last Friday indicated a lot of companies spending on IT equipment and software, and I think that's something that you're going to see continue going forward. Companies underspent on technology back during the last 10 years or so, and they're really now playing catch up, upgrading their networks, getting up to full speed. Companies like your Cisco's, symbol CSCO, IBM are going to benefit from that. Another factor, of course, is that U.S. corporate earnings and the U.S. economy are two different things now. A lot of U.S. companies have stepped up their exposure abroad over the last 10 years or 15 years. So what we're seeing is that those two things have decoupled a little bit. In other words, even if the U.S. economy slows down a little bit, we're seeing companies with solid international exposure really continue to do quite well. So some of the areas I would look at to play the ongoing cyclical recovery, again, energy I mentioned, technology I mentioned. The other area is industrials. Now, industrials is pretty much a catch-all group, includes everything from heavy construction to building power plants, to building out electric transmission networks, all sorts of different industries involved there, basic manufacturing. We've seen a lot of those companies also report solid results. We're seeing pretty strong demand and pretty strong pickup in a lot of areas related to manufacturing. Obviously, manufacturing industries have really cyclically improved here over the last 6 months or so. So that's a big positive for those companies. One company I would mention is ABB, symbol ABB. A Swiss company came out with an excellent earnings report a couple of weeks ago. Right now, they're seeing good leverage in their automation businesses, things like factory robots, factory electrical controls. Longer term, I think they're going to see a good push a little later in the cycle from their utility-related businesses like building out electric transmission networks. Apart from those, I would say that it's also a good idea to continue to have a little bit of focus on income. Now, one of my favorite sectors that I cover in the Energy Strategist, as well as in the Energy Strategist sister publication, MLP Profits, is the Master Limited Partnerships. These companies offer high yields and significant tax deferral advantages. And the reports out of these companies have been pretty stellar across the board. What we've also seen is that they benefit handsomely from really strong credit markets. The reason is because their typical strategy is to raise debt or equity and then use that cash to build assets like new natural gas pipelines, new oil pipelines, very much in high demand to serve a lot of these new onshore fields that we're discovering. These companies build these assets, they sign long-term contracts with producers to ship oil or natural gas across their pipelines. Those contracts are almost totally fee-based, have no dependence on commodity prices and very little relationship to what's going on in the economy. Good, solid midstream energy businesses generate a lot of cash, allow these companies to pay 7 and 8% dividends, distributions. I think they're going to do very well going through the end of the year. Look at any dip as an opportunity to get into some of our favorite names there, like Enterprise Products Partners, symbol EPD. Thank you very much.